that of Heiar Insurance, not WBEV or Good Karma Brands.
And welcome into Taking Care of Business today. Yet again, we are on a Friday, which means it's time for Senior Solutions with Heiar Insurance. We've got Matt Heiar with us today. Matt, chilly one out there, but looks like a little bit of sun came out, so not too bad.
Yeah, I mean, we know it's going to be cold. We live here, right, in Wisconsin, but it was really cold this morning. But that little bit of sun just, makes it still a good Friday.
It does make it a very good Friday, and we always think it's a good Friday when you're going to be here to join us on the show.
Oh, thank you.
We've got a lot to discuss and, of course, a lot of questions to answer for people. We will let people know if you want to call in and ask a question directly of Matt Heiar, you can do so. You can give us a call or text. Our number is 887-9595, and that's the call or text line, or you can call us at 885-4446. Our producer, Wally Lukashinsky, standing by for your calls and texts, and he'll be sure to let us know. If you'd rather talk to the Heiars directly, you can definitely give them a call. Matt, go ahead and share the number for the office there.
Yes, so we're located just up the road at Heritage Mall, and you can give us a call at 920-887-0580.
There you go. Stop in and talk to any of the superstars there, and they'll be more than happy to help you. I came with a list of questions because I decided to talk to some of my family friends who are getting close to retirement age, or some of them who are in retirement barely, but now they have questions about other things. So I'd love to get into some of those with you if you could.
Yeah, absolutely.
Right. So the first question I got asked was about, and this is something I hadn't thought about in forever because you used to see these ads all the time on television and they went away. But recently somebody said to me, hey, I've been retired for about 5 years. Our house is paid off. We own it outright. And we'd love to have a little extra money. And somebody suggested reverse mortgaging.
Sure.
How does that affect your retirement? Like, is it an option? Is it a good option? Like, is this something you've dealt with before? You've heard about before?
Yeah. So reverse mortgages, they have to make sense. So they are definitely not for everyone, because our house is like our biggest asset. Right. So it's essentially our bank too. If we have to redo the kitchen, we could take out a home equity, right? Based on the equity of our house. So it is nice to have that. But with reverse mortgages, basically we have to make sure, do we want the house? If we do, if you have no kids, no family, and your house is paid off, and you need a little bit more of an income stream, it could make sense.
Right.
They could give you X amount of dollars and you could invest it. And it's essentially a loan. Right. So you're taking out the equity on your house, and if you don't pay it back, then they sell the house and you pay it back that way. Or you could, because they only give you up to a certain percentage of the value of the home.
Okay.
So, because that's probably protecting them also. You could trash the house.
Right.
So it could make sense for some people, because I used to think when you saw those commercials, they made bad decisions. That's why they have to do that. But it is. I mean, we have our home, and typically our mortgages are cheaper than even renting a place nowadays. So it could make sense. There is a mortgage company that my mom used to work with that I could get you in contact with them. I've done it a couple times for people. That had them contact, and then we ended up not going through with it just because it didn't make sense. But the big thing is you have to have your house paid off. You don't have to, but the one person that didn't have their house paid off and we tried it, the amount they're going to give them was okay, it's not worth it doing that at all. Gotcha. So it's a situational, but yeah, there's been people that have invested it. They've bought life insurance with it, on their kids. It's just, it has to make sense.
And we've talked about before where if you still are paying on your house when you get into retirement, one of the things people like to do is say, well, I want to be debt free, so I want to pay it off. But if your mortgage rate's at let's say you got a really good mortgage rate and you're still at a 3.5%, 4%, but you could invest it and make 6%, that's the smarter move, and just keep making those payments.
Yeah, and as long as we account it, in your income plan, hey, yep, we have $1,000 a month going towards our mortgage, it's fine.
Right.
But at the same time, everyone's ultimate goal is debt free. I don't want to have any debt, and it's no, you can still retire, because a lot of people say I have 2 more years left in my house, so that's why I'm working 2 more years. Okay, and I just ask why, and not being devil's advocate, but at the same time, if we could make that work, just giving you an extra $12,000 a year to pay for your mortgage, why wouldn't we retire?
There you go. Okay, well, that answers one question. Next one is kind of interesting because we talk about how pensions have kind of gone by the wayside. I think I saw a statistic somewhere that says like less than 15% of Americans work in a position where a pension is even an option.
Very true.
But I happen to know somebody who worked for a railroad company. Actually, still does.
Okay.
And they're up for retirement here in about a year. I think they've already scheduled their retirement date. And they received something from their employer saying that they had some options for their pension. One of them being a pension lump sum option. And I guess there's some differences in numbers. It sounds like one's a smaller amount, but you get it all up front, and one's stretched out like a pension normally is. Any reason why you would want to take one or the other? Is this something that's normal with pensions?
Yeah, so it's very situational once again with people like if you're married, we want the spousal benefits. So we're choosing those because if you choose your life only, you collect 2 checks and pass away, that money's gone, goes back into the pension fund.
Right.
The lump sum options, depending on your other retirement assets, we do have some people take that. They're like, I don't need the pension. Between my Social Security and my spouse is still working and we have no debt. Maybe we do, roll that out into an IRA and invest it then. But pensions are just that warm, fuzzy feeling.
Right.
Checks are going to stop coming in, but not with a pension. That's guaranteed money. So a lot of times we're taking the pension, but we just recommend the spousal benefit. Even if your spouse that's when we do the widowed spouse test. Even if your spouse gets half of it, it's still something rather than losing your entire pension. So we just have to do a couple different formulas, to weigh the options and see what's best for us. But yeah, once again, very situational with that. And it's just much easier. People are living longer. So that's why these pensions are going away because people are living longer. They didn't expect, the health insurance costs. That's why we aren't getting retirement benefits through health insurance anymore. Right. So if you have the option for a pension, typically we're taking it. And it just makes our job that much easier for our income plan because we know that Social Security comes in. We know that a pension comes in. But it's funny that you say that your friend worked for the railroad because they don't pay in Social Security.
Really?
Yeah, so that's why, like, when we do a lot of these Social Security applications, they ask, did you work for the railroad? Did your spouse work for the railroad? And then they go to an annuity question, which says, did you ever work a job where U.S. Social Security taxes were not deducted or withheld? That's the railroad because they have their own kind of Social Security. That's their pension system.
Okay.
I know. I was, like, appalled by that, too. And even their Medicare cards, they're all different because they're railroad. So they paid into the federal government, but just a different entity.
That is really interesting. Now, I guess my follow-up question to that is that pension income, let's say you go with the monthly warm fuzzy of your pension, does that count as taxable income then?
Absolutely. So Uncle Sam hasn't taxed that yet. So it's taxable just like your ordinary earned income. So, yes, you want to take taxes out of that. And basically you have to file a W-9 just like we do if you worked at a job. And yes, but the kicker is we live in a voluntary tax withholding state. So you don't have to take out state taxes, but that's where I always give that form to your accountant. They know your full financial picture. Unless you're an advisory client, then we have a better understanding of it. But we don't have to withhold state taxes, but we definitely want to make sure you still are.
Right.
Tax time's scary enough.
And so that means even getting the lump sum option, that's still going to be taxed as a lump sum.
No.
It's not.
No, because we'll roll that money into our retirement account.
Gotcha.
So we're deferring the taxes until we take it out.
Okay.
Yep.
Okay.
See, we're learning things.
We are learning things. These are all, I had no answers to any of these, obviously, because, again, I haven't retired. Most people only retire once.
Yes, that's the goal.
So, not something you would get. This one, actually, the next question I got came from somebody who is not retired yet. They're still about 15 years out for retirement.
Okay.
But they are an avid lottery player. They got to get their ticket once or twice a week. And they said, okay, let's say I win. I go for the annuity thing. How does that affect me for retirement?
Yeah, so in the event this did happen.
Right. The very slim
Yes,
event.
this is not a retirement plan.
Right. Hope you're listening, buddy.
Honestly, like the lump sum is less, obviously, but $1 today invested today is going to be worth a lot more than getting the dollars later.
Right.
You know, so what we could grow that amount to in the time frame of the 20-year payout or whatever it is, you know, that's a long time for them to hold your money.
Right.
Not investing it. So they're going to give you, so like 20 million, it's hard to even say these numbers,
Right.
$20 million today, but they'll give you 30 million over 20 years. It's like, well, what do you think that 20 million will be in 30 years?
Right. Which, I mean, correct me if I'm wrong, and maybe you don't know, but isn't that kind of what the lottery agency does? They kind of invest that money themselves anyways.
Absolutely.
So they're getting that growth that you could be getting.
Yep. And a lot of financial institutions, that's what they do. They're investing the money on your money. So but that's how the world keeps ticking.
There you go.
You know?
All right. So that's good to know because, I mean, he seems to think he's going to win someday.
Yeah, we don't have a lot of problems and questions with retirement if you win the lottery. I've had some lottery winnings, but nothing in the millions and millions. That's
Right.
Which would be nice. And you could screw up a lot
Right.
with that. But I mean, you see it though. I mean, there's professional athletes that are making millions and millions and filing bankruptcy.
Right.
So just because we have that, we still have to live within our means of even our new means,
Right.
you know. So
Got to be smart with that money.
absolutely.
All right. Last question I was given was about something called RMD, or required minimum disbursements.
Distributions.
Or
Yep.
distributions.
Yep.
That's it. Sorry.
You got it.
My own handwriting is horrible. Somebody was telling me that they were looking at information about their 401k through their employer, and they are still working. They are officially past the earliest point they could retire, and still working full time. They plan on working up until their full retirement age, probably beyond. And they were looking at their statement, and there was a note on there about them potentially being required to start taking required minimum distributions.
Yes.
And they were like, I'm looking at this paperwork and I'm confused as heck. Why do I have to take? I don't need that money. I don't want that money. Like, what am I supposed to do? And I was like, I didn't even know that was a thing.
Yes. So basically, RMDs is what we call them because the government loves acronyms.
Of course.
But so an RMD is with the new Secure Act. It used to be 70 and a half. That's when you have to start. But then the Secure Act 2.0 came out, and they moved it to 73. So at 73 years old, Uncle Sam basically says, hey, you've deferred taxes long enough on this money. You got to start pulling some.
Okay.
Which typically 4 to 5%. And excuse me. So that is a lot of money if we've built up this huge 401k and never touched it. You know, so we got to plan according to that too. And typically RMDs or Roth conversions, whenever we do, we want to start dwindling that money down a little bit, is from 65 to 73 because, you know, we don't have to worry about the marketplace insurance and, you know, keeping our income low. And then once we're on Medicare, you know, we have basically 8 years, you know, to start planning on what we're going to do with that. And maybe we don't have to do anything. Like when we do a Roth conversion, that doesn't mean that we want to dwindle your 401k down to $0 and have it all in Roth.
Right.
Would that be great? Yes. But we just want to control, like, hey, you know, if you have $1 million, you have to pull out $50,000, whether you like it or not. So now, working. So that's another thing. If you have a 401k, like, and you work at a manufacturer and you're still working and you are 73 years old, you do not have to take RMDs because you are active with a 401k and you are with that current employer.
And of course, Uncle Sam's still getting some tax money out of you, so he's kind of happy.
Correct. Now, if you're working, contributing to a 401k, you're 73, but you have your old IRA 401k with your other company you're with, you have to pull money from that. So, or if you go back to work and you're working part-time, but you still have your IRA or 401k, you have to pull from that. So the only way we can get around that is we have to be working with that employer, and you do not have to pull from that exact 401k. Okay. So that's why people are like, well, I'm going to go back to work part-time just so I don't have to do that. No, and RMDs are so important because if we screw it up, It's a big problem. So there's an excess tax. So say hypothetically,
I've heard that in Monopoly, I think, once.
yes,
Yeah, okay.
It's not as cool as Monopoly though, because like say you have to pull $10,000. Okay, not a big deal, you know. Well, you missed your RMD, so there's a 50% excess tax. So now the government got $5,000 of that.
Right.
But then on top of that, we have to pay ordinary income tax. So say you had to pull another 20 or 2,000 for that. So now out of that $10,000, you receive $3,000 because we missed our RMD.
Okay.
So in RMDs are, you could have 10 different IRAs, traditional IRAs, tax deferred. So if you have 10 different IRAs, we have to total that whole amount up and put it into an RMD calculator and see what it is. So you could pull it from one of the IRAs. You know, you could pull that 4 or 5% from each one. You know, I mean, typically less paperwork if we just pull from one.
Right.
But yes, they total all of yours, and it's not household; it's just you. So
Okay.
that is a big thing. So they make a rule that they'll give you till tax time the following year. So say I turned 73 this year, I have until next April to pull that money. But then every year after that, December 31st. So they give you a little leeway the first time.
Right.
You know, but typically you should be getting stuff, you know, from your advisor or from, you know, your portfolios or 401ks or annuities that, hey, you're turning this age, you know, we got to do something. But that doesn't always happen. People don't always check the mail. Things get lost
Right.
in the mail, or we throw it away. You know, so that's why you have to be very vigilant on that age. That's a big age. It's almost like Medicare at 65. It's like, well, what do you have? We can't mess that up.
Right.
You know, so if once you turn 65, it's always worth giving us a call. You know, and sometimes we'll be like, hey, you're working full time. They have over 20 employees. You don't have to do anything. You know, but it's better hearing that from someone than just like, well, my neighbor said this.
So if you get to the point where you do recommend, like, okay, you should start dwindling this down. Obviously, the minute you pull anything out of it, Uncle Sam's going to get his share.
Correct.
Do you then recommend, if they don't need that money for anything, that they do roll it into something that's, you know, since they've already paid the taxes on it, that...
Yeah, I mean, there's many different options. Like we can convert it to a Roth, or you could open up a brokerage account, or you could just invest it in, you know, CDs, or if you want to just put it in your checking account because that's what makes you feel comfortable. There's
Right.
nothing wrong with that, but it's just dwindling it down. But it's just spending your money too, you know. So it's basically what we call left pocket to right pocket. You're putting your money from this account to this account, but you're paying the taxes.
Right.
You know, so, but we got to do it thoughtfully, and accountants are always on board with everything you do, because if you just start pulling huge chunks of it, you're going to be raising tax brackets, and then Uncle Sam is essentially just getting more.
Right.
But when it comes to taxation, we have to look at the big picture. You know, like, oh, yeah, you did raise a tax bracket this year, but we're worried about 10 years down the road.
Right.
Because taxes are at the lowest point they've ever been. Do you think they will go any lower? No, not at all. And that's why it might make sense. Like, hey, you know, I think we'll pull a little bit more now, just because I'm worried about in 5 years from now when we have to pull. You know, so we have to make that debate. We're worried about taxation over a retirement plan, big picture, not about just this year. And that's why sometimes the Band-Aid approach of like pulling bigger chunks and putting it into other things, you know, because that money's tax-free now.
Right.
You know, so Uncle Sam's going to get his money, but we still have some strategies, you know, and accountants have strategies where we can not pay, the tax bill can be lessened, and that's the ultimate goal.
And I guess pulling that money and putting it someplace where, you know, since Uncle Sam's already gotten his money, where it can be rolled over, it's tax-free, that puts it in one of those buckets where once you do retire, if, you know, call up Matt Heiar and like, Matt, I'm thinking about buying a boat. You're like, well, here's the money that's already been taxed.
Yep.
This is the money you can touch. This is what you can use for that if you want, as opposed to, you know, making a big mistake and pulling from the wrong thing.
Yeah, and that's why, you know, like we talked about last week, like those Roth accounts are huge, because you need $10,000 down for a boat, or that's how much it costs. If you pull from the Roth account, that's exactly how much you need to pull. It's a little different when we start pulling from IRAs or 401ks, because, now we have to pull what, 12,000, or what's our tax bracket? You know, and it all depends. Oh, are you still working? Well, that's going to raise us now, a tax bracket. So it's thought, and sometimes people are like, you know what, Uncle Sam's gonna get his money. I don't care. I want this boat now. I could pass away tomorrow.
Right.
And we can't tell them they're wrong.
Right.
You
'Cause
know.
you're the advisor. You're not in control of it.
Yep.
You're just
We give suggestions and stuff, but it's ultimately your decision. So, and that's just life in general. Like we're not guaranteed. So, we have a plan for your Social Security, when to turn it on. But if you come back and like had a health scare and you're like, you know what, I got to retire earlier. I'm turning on my Social Security. Okay, we have to adjust.
Right.
And that's kind of life in general, right? We don't know what's going to happen tomorrow, but we just have to go with it. We can only control today. We can plan for tomorrow.
Right.
But we don't know what's going to happen tomorrow until tomorrow comes.
Well, what I do know is going to happen is I'm going to read the disclaimer. This is, of course, a paid program. The advice and opinions expressed during the program are solely that of Heiar Insurance, not necessarily WBEV or Good Karma Brands. I kind of want to dive a little bit more into preparedness, because as I'm talking to these people, they're at very different points in their lives as far as retirement. And some of them are looking at very different things and looking at it very differently. The ones who are, I am still working. I plan on continuing to work. I'm in good health. I'm not going to retire until I reach my full age because I'm happy. That's great. He's got his plan set.
Yep.
But then there's other people going, I'm 15 years out and I'm freaking out. I don't think I'm prepared. And they're looking at everything going on in the world we're at now, and they're looking at their investments, and they're freaking out. Is there a, ideal recommended timeline? Like, how far out do you think is the ideal point to start thinking about retirement? I know there's no too early, right?
There's never too early. I mean, today, I think about retirement. I'm very far away from retirement. It's stuff you think about, and then legacy. Normally people don't think about I want something to give the kids. But we don't know and stuff. And there's going to be a huge transfer of wealth from the baby boomers to the next generation. I forgot. I was reading an article on it, and just there is a lot of baby boomers that hold a big portion of the actual wealth in our country.
Right.
And how is that going to be transferred? And what is Uncle Sam going to get? And all these different scenarios they're saying, because if you get a 401k, you have 10 years to spend it. So if your parents have a 401k and you're a beneficiary of it, you have 10 years. Even if you're working and you're a high tax bracket, you have to pull that. So do you do that in 1 year, 2 years, 5 years? But it has to be 10. So that's where you start, thinking about strategies like that also. And that typically comes in the slow go years,
Right.
when it's oh, I've been retired, for 10 years now, and I'm not going to run out of money. It's looking that way. Then it's how am I going to transfer this wealth? Because you've worked hard your whole life,
Right.
And you don't want to see it just go away. How am I going to protect my wealth? That's another thing, and that's why having Rob at our office with the estate planning and trust, and will it avoid probate, and these are all huge things to think about and that we've never thought about.
Right.
So, and that's kind of what we do. We always talk about, do we have a will? Do we have life insurance? Do we have a funeral trust? All these things, we've talked about it, but
Right.
just never take the next step.
I guess, it seems like, I think about where I'm at. I'm, 41. Still got many years to go before I need to worry about retirement. And I'm looking at numbers. Meanwhile, my wife, who's 2 years older than me, has no desire to look at any of that, because no matter what number she sees, it's going to feel like it's not the right amount. And anxiety kicks in.
Yeah, and there's always one spouse that does, that does the worrying or does the bills, or does the insurance, So it's, you meet many different personalities and stuff, but we can plan, but all of a sudden a widowed spouse comes in, this was not in the plan.
Right.
They did all the financials. They did all the insurance, So they're coming in need help, what's going on. And what we do is we just take it step by step, and it's very overwhelming. And obviously we just went through a terrible situation, and we can only go one step at a time. So it's basically, all right, let's talk about the checking accounts, the savings accounts. What do we have? Do we have an inherited IRA? Did it get transferred over? Here's the paperwork, and we just have to take it step by step.
Now, obviously, you see a lot of people there at the Heiar Insurance office that come in at different levels of preparedness when it comes to retirement. is there ever a point where, and I'm fearing the answer to this, where it's just too bleak? The outlook is just not good, like incredibly not good.
Do we have to have difficult conversations?
That's yeah.
Unfortunately, that is part of the job. Where, you know, and that was my biggest fear when I got into advisory, like telling people like, hey, I don't think this is feasible, you know, and I was always scared to, you know, tell someone that's terrible. They've worked their whole life and stuff, but you also have to be realistic, you know, and so that's why what really helped me was the technology, you know, putting the numbers into it, putting it up on the big screen, and just letting the numbers show like, hey, this is what our data is saying right now, you know, and it kind of like fills in the blanks. You know, you don't want to say, oh, what'd you do?
Right.
You know, because there is many situations where people are like, I had to pull from my 401k. I'm like, you got a 10% penalty on that plus your ordinary income tax. You're like, I know, but I had to do it because of this, this, and this. And a lot of it's helping out children, you know, and who am I to say like, oh, I wouldn't have done that.
Yeah. Let the kids suffer. No.
And you wouldn't
Right.
have. You wouldn't have, and you know you wouldn't have, but it's sometimes not the best decision, you
Right.
know. But now mom and dad are, you know, struggling through retirement, you know, just because they helped out their family, and we only have one family.
Right.
You know, so like we try to make things work and stuff, but yes, that's why we're seeing a lot of people go back to work, not because they want to, because they have
Right.
to. So, I mean, that is the ultimate goal, but that's why you cannot come in soon enough, you know, because we do complimentary consultations. We basically get to know each other. You know, do we even want to see each other again? You know, that's a very important thing. And then after that, you know, it's just hearing the advice. You know, you're not getting billed for this, you know,
Right.
and that's what people think like, well, I don't want to go in there because, you know, it's
Right. They're gonna send me something in the mail next thing you know.
or they say like, well, I didn't even know if I had enough money to even like talk to an advisor, and that's never the case, you know. And so many people there's been a huge shift in the last 20 years of people that are coming in for retirement, and they're like, yeah, 42 years, you know, 31 years, and that's just a rarity nowadays.
Right.
You know, now the jobs, people are moving jobs a lot quicker for bigger and better opportunities, which, yes, that's great for your career, but now we're having all these different old 401ks that you're getting statements from, or
Right.
people are getting these $100 pensions because they worked 5 years at this job. So that's where we try to simplify it, because we know when we get these statements, you're getting all these disclaimers and privacy notices and your statements every quarter. Well, that's a lot of paperwork. And if you have 3 or 4 different 401ks, that's a lot to
Right.
keep track of. So we consolidate, simplify. That's what we want in retirement. We can put all those in one account, you know, one statement. You could go paperless if you'd like.
Right.
You know, you could have an application on your phone where you could look at it every day if you want. And you could diversify it how you want, you know, and preserve it and make sure that it's right for you. So it's just little steps like that where we just meet. There's people that are 15 years out. We meet once a year and just talk.
Right.
You know, how we doing? What, you know, and they're like, yeah, you know, I started doing this. I started saving this, started putting money, put it in a high interest checking account. Didn't even know the bank had it until you told me that. Like little things like that. Like you're not even working with us, but we're just talking.
Right.
You know, and that brings people peace of mind, you know, even if you are 15 years out.
Right.
Or we'll start a little Roth IRA and you're putting $100 a month in. You know, just little things like that. It's like that bucket that you'll have, that Roth IRA you thought was nothing,
Right.
you know, grew to this. And not saying it tripled in size or quadrupled or anything
Right.
like that, but it's a different tax. You know, when we go into like, oh, we need 5,000, the furnace went out.
Right.
Where do we pull from? And we can.
And I imagine some of the difficult conversations also have to stem from expectations. I mean, I know people who they're not calling anybody out, but their current living situation is very much paycheck to paycheck. You know, their savings are next to non-existent. They're currently relying on like, oh, that 401k and Social Security is going to be what saves me. But then they also have this plan in their head that retirement's going to come along and they're going to have the boat. They're going to have the RV. They're going to go on cruises all the time. they've got this mindset of this is what we're going to be doing and spending money on. If they come in and talk to you and say, well, this is what we want to do, but here's where we're at, you can have that realignment of expectations with them, which could be a tough conversation.
Realignment, or okay, how are we going to get there? And it's such simple things, like that we never think of. Like, hey, you could call your 401k company, and you're matching 3%, and so is your company. What if we go 4%? Let's see how that does. We'll do it for 6 months, and because we don't want you eating TV dinners, but statistically, more people than ever right now are living paycheck to paycheck.
Right.
So, and then some people cannot save. They just can't. If there's $100 left in the checking account and we don't get paid till Friday, it's like, okay, all right, well, I can eat out at least once.
Right.
And that's just the mentality, because we're physically seeing it now, and we have access, to our checking accounts. Back in the day, we had to wait for a monthly statement.
Right.
And it's like, it's probably pretty close. Better not buy anything.
Right.
It was almost better. But now, like, if you're like, they take out 1% more of your check, you can't touch it. Or if you have automatic bank withdrawal of, into your Roth IRA, like, I don't see it. And that's how we save. It's a lot harder than just like, okay, I'll take $25 from this check and I'll put it away. I mean, people would have Ferraris if they do that. It's very hard, the willpower to do this, but there is certain ways, and it's psychological. But that's why, yes, like, they are asking your 401k company, do you offer Roth? Maybe you could be putting 4% in of Roth and 4% into traditional.
Right.
Like, these are just like simple questions where we'll sit down and talk and, just spew out little tidbits of advice like that, like, and you will notice the growth.
Right.
So if you have extra money at the end of the month, you're like, oh, well, maybe I could put an extra 2% in. And that's just a simple thing, and it didn't cost you a dime, and you did nothing, and you don't notice it.
I almost wish there was something that was, maybe the auto withdrawal is the way to do it, but I think about how many times I know people, myself included, where I forget that, my Netflix is drawing every month automatically, or, your Spotify or whatever it may be, and you think, oh, well, it's only $15 a month that's getting pulled. That's nothing. It's nothing. If we did the same thing with retirement money and just thought of it as, well, that's just nothing.
Oh, yes. And like a lot of the younger people that come in, we do budgeting, so where it's like, all right, and this is where we need transparency.
Right.
Like, if you have the Netflix account, that's fine, but then we have to start prioritizing.
Right.
Because you're like, okay, if you're losing sleep at night and you're 15 years out of retirement, what is a need and what is a want? And it's so hard nowadays.
Right.
But these are the little things that we don't have to have that awkward conversation when you turn 60, 65, whenever you decide to retire. You did the due diligence of doing that, and even talking about it.
Right.
Because we can talk about it, but we have to act. So the first step would be just giving us a call.
That is very true. Absolutely.
At 920-887-0580. And we can, just chat. There's no, like you're signing a contract. No, absolutely not. And if we want to work together, absolutely. But this isn't like you get billed. That's what I think a lot of people fear. They're like, oh, well, if I go there, I'm wasting your time. And it's like, I have to be at the office no matter what.
Right.
There's a lot of clients and a lot of customer service. So absolutely, it's, I'm going to be there anyway. And if you want to chat and if it gives you peace of mind, you might tell a friend like, hey, yeah, like he really gave us some good advice, and we're on track now for saving, and it looks like we might be able to retire earlier. And you don't know that unless you talk to someone.
Right.
But we can't just talk about it.
Right.
And that's what a lot of the stuff we do, we talk about, with the estate planning, the wills, the trust, the power of attorneys. Things do happen, so we can have a game plan, but that game plan could completely change because of a health scare, anything.
Right.
We move, and that's where we have to evaluate that and get to know each other before we can make these decisions.
And it really is hard for people to talk about this. I remember growing up as a kid, like coming downstairs one night and walking into the kitchen, and my dad being upset that I walked in because they were balancing the checkbook and going over budgets. And that wasn't something for kids to worry about or kids to see or whatever. You know, you'll deal with this when you're older and you've got a job and you've got your own money. And that was just kind of how he was raised and how his parents were raised, that you didn't talk about this stuff. You didn't go over it. And, you know, you got to kind of break that stigma and be like, no, talk to somebody.
Yes. I mean, budgeting is huge. And now it's just so easy to, like, especially like watching sports. You know, now all these different streaming services are like, oh, the game is only on this channel.
Oh,
this
goodness
channel.
gracious, yeah.
And you're so mad about it, you know, so like I boycotted it. I'm like, I'm not doing it and stuff. Well, then you're missing out on the games, and that's basically why you have cable, like for me, that is. And you're like, okay, I'll purchase it, but I'll cancel it, or a 30-day free trial. Right. And then after that, it's $20 a month, and then you forget about it.
Right.
You know, so like if you do start going through your actual statements, you know, and I think a lot of that is with, you know, we have the applications on our phone. You can go paperless and you can see firsthand, you know, like, wow, look at all these little, you know, it's only $10, $15. My wife always used to get on me. You stop at the gas station every day, you know, and I'm like, you know, it's like you have to pick and choose.
Right.
She was acting like my mom. I'm like, oh boy, but it is, you know, it adds up. Right. You know, if you start looking at the big picture of like, how much is that a month? How much is that a year? Holy cow. Like, that's a car.
Right.
So it's just little things like that where, you know, we have to talk about that. And if we'll have it, like, you know, younger people bring in their statements and be like, wow, why are you spending so much on this? You know, and sometimes it's, well, I really like my streaming services. Right. I really like DoorDash.
Oh, yeah.
A lot of these younger kids are doing DoorDash. It's like, get in the vehicle and go. You are paying an inflated rate. No offense, DoorDash is great, you know, in crunch time and stuff, but that is how people are eating out now.
Right.
And it is so much more expensive, and eating out is another one also. It's great. It's a social activity. You know, we're cooped up with winter and stuff.
Yeah, you just want to get out and enjoy some time. And
absolutely. And it is therapeutic. I mean, it doesn't mean we can't, you know, but if it's like, hey, we said we're going to go on our date night once a month.
Right.
You know, and it's a guideline. It doesn't mean like this is it.
Right.
Like if I see you out to eat, you know, I'll be like, hey, saw you 2 weeks ago.
Come on over the table and be like, we talked about this,
no,
buddy.
No, it's not, because there's events and things happen and stuff, and quality of life, you know. But at the same time, even if you listened and followed that guideline half of the year, that's more than you did the year prior.
Right.
So little things like that is just, and it adds up, because we're looking at, you know, 10, 15, 20 years, you know, down the road where it's like, wow, that really, you know, that really did add up. And that's huge, just from little things like that.
And you did say a phrase in there that's really kind of key to it. It is really about quality of life. You know, if you want to have a certain quality of life when you retire, you got to plan for that. You got to prep for that. You got to think about that. And if that means making some changes now, you know, I always joke, you know, my kids are like, you know, oh, can we get Spotify for the house, get a family plan? I was like, you know, the radio is free, right? You just turn it on, it's there.
I work there every day. You could hear me.
Exactly. Yeah, which is why they don't want it. Or, you know, there's other free options out there that you can use for, you know, whatever. Or, you know, my wife, she loves, it's a streaming service called Friendly, because it has the Lifetime stuff on it for the holidays.
Sure.
It's like, great. So when the holidays are over, we're canceling it, right? And she's like, well, I can go back and watch some of the holiday movies, you know, throughout the summer as well. I'm like, but you don't. We never do. And inevitably, I'll cancel it without her knowing. And then, of course, she won't realize it till the holiday movies kick up again in the fall.
Sure.
So, you know, sometimes you gotta make those hard decisions. You did say something about 401ks I wanted to ask about, because I'm thinking about my particular 401k. And every time I've gone from one job to another with 401k, I've always rolled it into the new one.
It's perfectly fine.
But you don't have to do that.
Well, you don't have to. So, there's a couple different options. Like we were talking last week about in-services, right?
Right.
Like where you could, like some people are taking money out of their 401k prior to retirement just to put it into an IRA and have different, you know, allocations.
Right.
So it's not just in that portfolio. Excuse me. So the same thing applies for you rolling your money into your 401k. Like you're rolling it in, might be cheaper fees, you know, and they might have a great spread of portfolios, or, you know, different investments. It makes sense sometimes.
Right.
But like initially we're just thinking convenience, right? I have this money. I don't want to get statements from them now because I have this company. I just want to roll it in.
One statement instead of four,
Yes.
whatever. Yeah.
And so that makes sense. But looking into it, because a lot of these, 401ks are just target dates. You're going to retire at 2035. Okay. Well, what is all in that, And that's why we want to make sure that it makes sense. So like I have people come in all the time and I'll say, absolutely roll that in, or it might make sense to do something else. So that's a situational thing also,
Right.
but our natural instinct always is like, done with this company, moving to this company, let's put this in this. And a lot of times that is what we do, but it's nice just to look into it. So that's a great question.
It's good to know. I guess I never even thought about it or considered it because I think every time it's just been like, we no longer work there. Here's how much you've got. And, do you want us to cut your check? Or do you want us to roll it?
It'd be nice to have that check.
It's like, sure, that sounds like a great option. We got a few minutes left on the show, and so I want to take a moment to talk about kind of the relationship of what you guys have going on over there because, we talk a lot about retirement. Mm-hmm. Prior to us getting into the retirement conversation over the last couple of episodes, we talked a lot about, Medicare and health options.
Yep.
You guys also have Rob Mielek over there helping with that estate planning, that end-of-life stuff. Talk about how those integrate. If people want to talk, like they don't have to come to you for all three. They can come to you for all three. They can come to you guys just for one. But there can be different conversations. It's all approached a little bit differently.
Yeah, and that's like so like when I first started, my mom, she's been doing the Medicare and health insurance, life insurance for so long. And then she taught me that, and it was great and stuff. And then she had Rob at the time, so did the estate planning. And it felt like a lot of people are like, well, I have this 401k. What do I do with this? And we didn't have the retirement aspect into it. So it felt like, I couldn't fully help people.
Right.
So like I was thinking and all of a sudden started doing some schooling and went back and, I got my securities license. So now it's like, okay, now people can come in and we can help them on all aspects and have a one-stop shop, like where it's, and I don't like saying one-stop shop, but
Right.
essentially in our clients range, like you said, we have clients that do one thing, three things, two things, and there is not a right answer.
Right.
Like if you have an advisor, perfect. And you like your advisor and you're happy, absolutely. There's no reason to switch whatsoever. We can still get you Medicare and maybe have you talk to Rob about estate planning or getting a trust or power of attorney.
Right.
So it's very diverse how we work with people and stuff like that. But there is no like, we only want to work with you if you do everything with us.
Right.
And some people do like that convenience, but at the same time, it's no. We'll talk to anyone and everyone, and we just like supporting our local community.
Well, it's got to be nice because I imagine if you're, let's say, talking with Rob about stuff and he's like, well, what is your current, financial situation? What are you looking at having to potentially have for end of life planning? They could be like, hey, Matt, down the hall. And you could be like, yeah, actually, let me grab your stuff here. Let me grab your portfolio. Let me help you with that information. And you don't have to worry about, your end of life planning person saying, your retirement planning person's an idiot and doesn't know what he's talking about.
Well, I hope Rob hasn't
Right.
said that about. But no, like when I refer Rob, my clients to Rob and stuff like that. If they're advisory clients and stuff, like I will sit in that meeting. And some people are like, no, we're good. It's all situational. But if that's what you want, like you're,
Right.
like, I'd feel more comfortable if you're there. Because we first met you. Yeah, absolutely. That you just got to let me know.
Right. It's just a great symbiotic relationship you guys got going on over there. Right now, I'm guessing if people need to call you, want to schedule an appointment, come sit down, is there a long wait time or you're like, well, we're booking out in April?
No. If you want to see me, we'll get you in. But that's the first step, right? We have to act on it though.
Right.
So you can call and all we do is talk and you're not signing any papers. There's no like, oh, well, you came in here. Now you owe me. No, not at all. We can just have a chat, and what is your concerns, and that's basically what the first appointment is. Hey, my name's Matt. This is what I do. I've been doing it for this many years. This is my family business. Born and raised in Beaver Dam, and that's, getting to know each other is the biggest thing. And that's step one.
Right.
And if we work together, that's perfect. If not, a lot of times we'll look at people's portfolios and we're like, you're good. I mean, this is great. Like, absolutely. I wouldn't change a thing. And they're happy about that.
Right.
And nothing happened and stuff, but it gives you peace of mind. And that's what we look for nowadays.
Peace of mind is definitely an important thing to have. I'm going to give the number out again, 920-887-0580. They can give you guys a call if they want to book an appointment, talk to you guys, have questions. I highly recommend that they swing by and talk to you because you guys are friendly. And who doesn't know the Heiars in this area, right?
No, absolutely.
So, stop in, local advisors for everything with Medicare, retirement, and estate planning there as well. And so I guess the only thing left to say is, of course, if you want to retire,
Call Heiar.
this has been a paid program. The advice and opinions expressed during the program are solely that of Heiar Insurance, not necessarily WBEV or Good Karma Brands.